Climate Bonds team, I would like to extend a warm welcome to you all. It's only 13 minutes past 9 and the energy is buzzing here on Bishopsgate. My name is Constance de Wavrin and I am here as Global Co-Head of Market Engagement and Partnerships. And I have the privilege to declare the Climate Bonds Connect 2023 Global Conference open. Today's theme is Ready, Set, Transition. We have a packed agenda with thought-provoking discussions addressing the most pressing topics in sustainable finance. Now look around you. You are surrounded with professionals who, just like you, are involved in shaping the future for a better world. Now, the main event will happen in this room, and allow me to go through a few admin details. So first of all, we are not expecting any fire alarm. So if you hear a drill, please take it for real. We'll have the main event team coming in with high visibility jacket and showing you the exit, and our designated assembly point is Exchange Square. Aside from the main event, we'll have two exclusive side events. At 1 o'clock, we will have my colleague Anna Diaz orchestrating an electrical utilities consultation roundtable. And at 12:15, I will be hosting a briefing on sustainability-linked bonds with my colleagues. Both of these will be happening in the two rooms outside. Now, at the end of each session, there will be a Q&A, and through the Wava app, you'll be able to submit your questions. That said, if you are in the room today, you can also prepare your questions, and when the time comes, raise your hand, and we will come with a microphone. This is a hybrid event, and I'm pleased to say that we are joined by 1,800 online participants today from 120 different countries. Now, on the Wava app, you are able to access translation caption in 30 languages. As mentioned, you can submit your questions. If possible, please do it in English, but there is facility to translate as well. And I should say that the recordings will be available on the app for a month after the event, should you miss any sessions. Now, before we dive into the conference, I would like to express our heartfelt gratitude to our amazing sponsors, Main Street Partners, Moody's, BNP Paribas, the Luxembourg Green Exchange, QSIP Global Services, Ashurst, CFA Society UK, Scotiabank, Mizuho, ICMA, FSD Africa, ESG Book, and Arabesque. And I should also mention our media partners, Bond Radar, Environmental Finance, and SRI Event. Without your support, this event would not be possible. And without any further delay, I would like to invite Doris Honold, Climate Bonds Chair, who will be sharing her opening remarks. And in the meantime, thank you for being here, and we look forward to your participation.
Dear guests, a very warm welcome, and I'm delighted to say hello and open up the Global Climate Bonds Conference 2023. We've heard the theme, Ready, Set, Transition, And indeed, it's exciting times for the transition to net zero. You have seen the recent IEA report, which confirmed that fossil fuel demand peak is now across all areas of our economy. Electric cars on the road today are already replacing 1.5 million barrels of oil a day. This is demand that is gone. It will not come back. If we look at the US, the IRA, considered transformational worldwide, has its 1-year anniversary in August. Researchers estimate that the IRA has resulted in the US speed of emission reduction being double than what it was before. Companies have invested $270 billion in clean energy projects, but most remarkably, it has resulted in a mindset change. In many US states, if you say climate change, if you say transition to net zero, people equate it with jobs. Climate change equals jobs. The IRA has created 170,000 jobs in the US. If you look at Japan, Japan has just announced the first sovereign transition bonds. They're planning to issue $133 billion over the next 10 years to help Japan in its transition to net zero. But not only governments, there are many examples across corporates, big and small. If you look at Germany, Sixt, Germany's leading car rental company, they are replacing their fleet to have 90% of electrical cars by 2030. They're investing 50 million in its own charging infrastructure, and they have already ordered 100,000 electric cars to be delivered over the next 6 years from China. It's hard for a German company, but you see, and I'm sure all of you have many examples which really 5 years ago, we would have thought really ambitious. We have made progress. I also know that there are setbacks. There are disappointing news. This week, in a week where we have confirmed that 2023 is the hottest year on the record, we hear about new oil drilling licenses. There are disappointments, there are setbacks, but the main point is not to lose focus. The world is moving. The world is transitioning. The problem is it's not transitioning fast enough. We are still heading for catastrophic climate change. That's why we need to keep on pushing. We need to fill the trillions and trillions of dollars of financing gaps. Companies have to do more. Governments have to do more. We need to have more collaborations across public and private. We have to more collaborations across regions. Most of all, we need to have transition plans everywhere, every country and every company. Transition plans will be your license to operate. Without a transition plan, banks will not lend to you. Without a transition plan, you will not be part of a company's supplier network. And without transition plan, you will not be able to participate in the opportunities for growth and profits generated by this transition. So with this ready, set, transition, I'll hand over to Sean Kidney.
Thank you, Doris. Thank you very much. A little bit of history about Doris. Apart from doing quite a long stint as the Chief Operating Officer of Standard Chartered Bank, she's a Chief Risk Officer by training, by temperament. We have as our chair someone who is focused absolutely on risk. And this is the theme that I need you all to embrace and support. This is fundamentally about managing risk. There are two kinds of risk we've got to worry about. There is the risk of impact and negative risk in our portfolios that the central banks of the world are doing such a good job of making us aware of through the network we're greening the financial system. And by the way, this is now 150 central banks around the world. working together on looking at these kinds of risks. But there's another risk. And this is a risk I really want us to think about today. This is the risk of missing out. This is the risk of not being able to take advantage of the opportunities that are coming through the system. This is the risk of not having bought Tesla shares when they were worth nothing. Because in a world of volatility, in a world of rapid change, in a world of extraordinary change, there will be many of these kinds of risks that we need to address. How we address them, of course, is another matter. As Doris says, we still have rather a freight train coming on the tracks of us. 1.5 degrees will be breached the next 4 years, according to the World Meteorological Organization. The IPCC says we have to get emissions down 60% by 2035 to have a reasonable chance of a future for our kids. Not a target, it's a minimum requirement. And we're not on track yet. We know that because we're going to get 1.5, we're going to get 1.8, and we'll hear from Jacob Tolmer in the next session about why he thinks the inevitable policy response, we have a good shot of plateauing temperatures at 1.8 and bringing them back down. We know at 1.8, things get ugly. The heat we've seen last summer around the world, the hottest year on record yet again, is nothing, absolutely nothing compared to what's coming through the system. We'll hear from Cathy Bowman-McLeod about heat a little later in the morning. We need to prepare. We need to make sure now that the resilience side of our conversation is a big part of what we're doing. Yes, we've got to get emissions down. That is a given. That is absolutely certain. But now I worry. I worry for the vulnerable and the poor who don't have access to air conditioning when we get wet bulb temperatures around the world. That is the sort of heat and humidity ratio when we no longer perspire and we start dying in the street. That is one of the predictions, by the way, one of the certainties, let's be clear. I worry about people dealing with disasters in everywhere from New York to Shanghai to Jakarta, and how we cope with those when we are so ill prepared. So resilience is on the agenda. The capital we have to invest in the next 20 years is about $150 trillion US. It is not 100 billion. It is not $1 trillion a year. It is an extraordinary figure. But as you've probably heard me say before, we are lucky on this planet. We have the capital reserves. We actually have the capital. We have large pools of savings in multiple jurisdictions around the world, which could be deployed if we gave them solid returns. And I say this because this isn't a matter of investors taking a risk to save the planet. This is a matter of constructing the risk so we can get win-win, so that our investors can get a return, because I want my pension paid when I retire, as well as addressing sustainability. And it's not a bonus feature, because if you're a large investor, a universal owner, as the language would be, you require the economy to improve. Stock picking your way out of problems is not going to be a great solution here. That's like shuffling deck chairs in the Titanic. We need the Titanic to change direction if we are to ensure the financial sustainability of our portfolios, of our investments, of our savings. We need investors, banks, corporations to work with government on how we do this. It's not rocket science. We have mobilized before in war, in other situations, goodness knows, in 2020 during the pandemic. We've seen we can mobilize. We just need to do more of it. Having said all of that, I'm actually here today excited. I'm really excited because in the travels, the conferences I've been doing around the world this year, the meetings of governments, there is something in the air. There is an excitement that change is happening. The supertanker is turning. It is rather the 11th hour, 5 minutes to midnight. But there is no doubt that in all the major economies of the world, there is an extraordinary ferment of action. Hey, don't get me wrong. There are plenty of forces fighting to stop things. I heard last night about the Saudi negotiators in the UNFCCC cleverly looking for ways to slow things, which is at odds with some of the Saudi industry who are investing in green transition. In every government, there are competing forces. In the UK, we have the lunacy of providing more exploration licenses for oil and gas in the North Sea while we try and commit to climate change targets. We are not pure here, I can tell you. Every government is the same. Well, maybe a couple like Denmark are pretty pure at the moment. Those forces exist everywhere, but generally the change is extraordinary. I trace this back to the Biden Climate Summit a couple of years ago, when we saw the major economies of the world commit to 2030 targets, not 2050, but 2030, the ones that I focused on, significant emissions reductions in the near future. And since then, we've seen policy. You heard Doris talk about the IRA, Inflation Reduction Act in the US, creating jobs in Republican states, creating jobs in places that will ensure 80% of new jobs in Republican states that will ensure that this stays even if there's a change of administration. Remember that. In Japan, where I'm next week speaking to METI, the Green Transformation Program funded by this climate transition bond that the Prime Minister announced a couple of weeks ago at a PRI conference with Margarita Pirosca in the front row here, is incredible. 4 trillion yen of subsidies, 150 trillion yen of mobilization of capital. Is it perfect? No. Is it an amazing step in the right direction? Yes. Momentum has begun. In China, which has been doing this for years, we have incentives, we have subsidies. The regulators require banks to hold in their portfolio 5% of their bonds as green bonds. We have green guarantee schemes. China has built more renewable energy this year than ever before in history, and more than any other country in the world by a country mile. And so on and so on and so on. In Europe, where Repower EU, Invest EU, and various EU programs, including the Sustainable Finance Action Plan that I've been so involved in developing and supporting over the last 5 or 6 years, has really shifted the terms of debate. And yes, there's a lot of fight back, as there is everywhere, as people are saying, hang on, this looks hard. It is hard. We have to change the global economy in an incredibly short period. We have to remove fossil fuels, which have given us wealth, which have given us this world we live in, and replace it with clean energy everywhere in a few short years. We have to shift agriculture. We have to shift industry. We have to shift our urban environments. Of course it's hard. But there is no other choice. Because if we don't do it, we don't have a future for our children. But let me just go back to the wins. Oh my God, the wins we've had, the state action. And don't forget that the reason we've seen such a massive uptick in renewables in the last couple of years has been state action. It was Germany in 2001, the Green Party, that pushed this through, a coalition government that introduced the feed-in tariff that engineered large-scale offtake agreements for renewables and started the price reduction. And then China picked it up in 2006. Thanks to China's large-scale procurement of renewable energy, the price dropped like a stone. And everywhere else in the world is benefiting. We expect to see continued, on average, 20% reduction in the cost of solar every year for the next 5 years. According to the solar scientists I'm speaking to, that is absolutely what's going to happen. This is a new era of cheap energy. Forget this idea that we're going to have to pay more to go green when it comes to energy. This is going to become cheaper. The second win we've got is, as a result of all of this, we have investor belief. I don't have a conversation with major investors around the world anymore about whether this change is going to happen. The conversation I have is about speed and how we're going to pick winners and losers. There is a belief now that the future will be green. In fact, most people say that decision has been made. It's how. How are we going to get there? How quickly are we going to get there? That is a win. Green bonds are simply the proof of concept. We've seen green bonds grow from 4 billion to 4 trillion, thereabouts, green and sustainable bonds since we began work years ago, thanks to the work of so many people in this audience, in the finance sector, in investors. It's been an investor-driven market, in China, a regulator-driven market. But it's only a proof of concept. It's not the end game. The real issue is how we shift capital across all asset classes, which is starting to happen. The third win has been regulators. We've seen that amplification of the agenda. The central banks, as I mentioned, taxonomy guidance. 50 countries now have taxonomies, which is a shopping list for the future. That's all it is, everyone. Looks hard when you first get it, but once you start using it, it's actually pretty easy. And a key win in that taxonomy conversation, it's about the science. It's not what the Ministry of Finance thinks. It's about the science. We've managed to hold that line. And that's what we've been failing to do for 30 years. That's why we're in this problem, not listening to our science adequately. There is a tsunami of change now, evidently, clearly, obviously coming through the global economy. In emerging markets, a commodities boom is shaping up. Everyone knows that. Nickel, lithium, copper, rare earths, vanadium. This will replace the fossil fuel boom of the past. But it applies in industrials too. In Japan, there is a clear sense that the future for Japanese industry is to deliver the tools to turn our world green. And that's the basis of the green transformation, climate transformation program there. It's time for us to reframe this conversation. This is now evidently, overtly about opportunity, about the opportunity involved in electrifying the planet. We need to quadruple electrification in the next 25 years. Think of what that means for investments, grid companies to battery companies. Read the science about the patents that Toyota has put out recently for solid state batteries at half the weight in cars, which will give us double the range for lighter cars. Or read about sodium batteries, which are cheaper, which now I think there are 8 companies around the world, 7 of which are Chinese, building sodium batteries, which are way cheaper for power storage. The evolution is amazing. Heating, the current boom in heat pumps. Industrials, cement, low carbon cement is going to be driven by government mandated procurement because it's possible now, because the low carbon cement is there. In chemicals, the replacement of fossil fuel feedstocks by bio feedstocks and other kinds of low carbon feedstocks is starting to happen. And then in land use, such an important area for us when we try to deal with biodiversity and nature. You know that 80% of agricultural land on the planet is devoted to livestock and growing feedstock for livestock. That is extraordinary. We could probably be a little bit more efficient about this. We could probably convert large chunks of the UK to forest, to sequestration, with just a little bit of a change of how we manage our meat and protein production. Well, it might be a big change. Singapore has mandated that by 2030, 30% of the food consumed in that city-state will be grown within Singapore's boundaries. GRC, Temasek, the state investment funds, have been investing accordingly around the world. This is going to happen. Plant-based food, lab-grown meat, all of these things are part of the mix. This is a revolution underway. I mean, the simple revolution is simply to grow feedstocks from algae and stop depleting our anchovies from the coast of Peru. The biodiversity benefits as a result. But also we have a volatility problem in land use. In a world of temperature anomalies, droughts, floods and storms like the one we saw in Acapulco just a couple of weeks ago, an unbelievable hurricane, we need to start thinking about how to manage volatility better. At the same time, we've got artificial intelligence coming along with all its predictive capabilities. We can, if we roll that and make it available to the poor farmers of the world, not just to the rich farmers in Iowa, improve the capacity of individuals to predict and survive crises. Today, we are launching our Brazil Agricultural Investment Opportunities Report, which gives you a sense on the land use and agriculture area, the kinds of opportunities we have. We, of course, need to move to deforestation, improve deforestation, but we have a win because we have the Brazilian government championing this and pushing this and looking for global models at the moment. And it'll be on the agenda of the G20 this year. There's one thing I would like to leave you with when it comes to the opportunities, an idea. Scale drives learning rates. Scale drives cost reduction in all of the areas I'm talking about. If we can engineer, this is a policy issue, if we can engineer large-scale demand, the price plummets. That's the lesson from 2001 with the German feed-in tariff and the Chinese picking it up in 2006, which has driven down the cost. It applies everywhere. That is the policy lever we will be working on with our colleagues at PRI, UNEP and others in the next couple of years. Our role in this room is to make it easy to act. Our role in this room is to make it easy for capital to flow. Our role in this room is to ensure capital does flow at a larger scale than it's currently flowing. Hey, we're doing well. We're about $1.5 trillion a year flowing to climate solutions. It needs to be $10 trillion a year. We've made a start. It's 10 times more than it was 10 years ago. But we've got a long way to go. Of course, that means for all of you, you've got a job to do. You've got a career in this. The next 10 years, multiply by 10 the capital flows, making sure while you do it that my pension can be paid, please. Bear that in mind, right? Next, you will see more on guidance about what to do and how to do this. You'll see improvements in the usability of the European taxonomy. There's engineering work we're doing at the moment to make the tools easier. You will see more from us on resilience investments and what it means, economic resilience, social resilience, as well as physical resilience. You will see a lot more about transition plans, as Doris said, how we assess them, how we monitor them, how we ensure they stay on track going forward. Investors are deeply concerned about these tools are coming to fore. You will see much more in the second area, deep collaboration between corporates, investors, and government, as we are now seeing in Singapore, as we are now seeing in Denmark, as we are now seeing in Japan. Early days, but exciting days. Everywhere, we need a deeper collaboration. Corporates cannot do this by themselves. Unless the enabling policy, the demand aggregation is there, for example, in the cement industry, we will not be able to get the corporates to make money. But if we work together closely, as we are used to doing in places like China, we can make this transition. It does require close collaboration. But lastly, you will see effort around what I'm going to call smooth transition. We are going into crazy times, ups and downs. Volatility is the theme of the 21st century. Managing volatility is what we have to do to be able to survive it. Every time something goes whoosh like that, we risk implosion. We risk Somalia, or we risk Donald Trump. I said it. The politics of populism will dog us this century. Populist, ill-informed responses will set back the cause of mitigation, will set back the cause of resilience. We have to be thinking about smooth transition economically, smooth transition socially, because if we are not thinking about smooth transition socially, we will get blowbacks. Think the Gilets jaunes in France. We cannot afford that kind of backward 2 steps every time we take 3 steps forward. We don't have the time. That's why just transition must be on all our agendas. Sure, it's important for equity reasons, but it's important because we need to ensure we make the transition, and we need to ensure our investments are sustainable. We don't make money on volatility. Well, let me rephrase that. The banks make money on volatility. Got a few bankers in the room. Every time things go up and down, they make money. From investors, it's a bit of a problem. We see value destruction with volatility. There will be challenges around food. There will be challenges around health. Pandemics will happen every few years. That is a clear and straightforward prediction from our scientists. and there'll be challenges around conflict. How do we prepare for this? How do we ensure that we have the funds available to step in of crises so they don't fester and blow up on us? The UN Disaster Risk Reduction Agency says that only 2% of the funds allocated to disaster relief are pre-agreed, 2%. So we've got to go out for a begging bowl every time it's a disaster. This is not going to be an easy thing to do if we get a disaster every 2 to 3 years. We need to make sure that our international institutions who step in disasters, whether it be central banks, the World Health Organization, or the UN High Commissioner of Refugees, have delegated authority to step in when a crisis happens so they can move fast. We've learned from central banks in the last 10 years how critically important that is. We need the G20 to figure out how to delegate authority. We need to start stockpiling food and other kinds of resources. We need, above all, to remember a learning from studies of earthquake resilience. San Francisco the city has studied how people survive earthquakes. 40% of the predictions of lower mortality, or rather evidence of lower mortality, comes from one thing: how strong a community is, how much a community cooperates, how much a community supports each other. 40%. They are now funding block parties around San Francisco as a way of building communities as an earthquake resilience measure. This applies to the world, everyone. The more we support each other, whether it be in China or the US or Europe or Tanzania or Indonesia or Ecuador, the more we are likely to reduce loss of life, to reduce loss of investments, to have a sustainable and smooth transition. Our job is to figure out how to make that happen. That's the next frontier. Thank you.